Okay, I think everybody is in and we can probably get started. So, all of you guys know this year we already have this a new law that has already taken effect where you have to report to the FinCEN about your LLCs and your S Corps and C Corps. So, they want to know about your ownership or beneficial interest of people in your company. But there is something interesting happening in California right now. California is always an interesting state, right? They're always looking for ways to grow more revenue for the state. So you guys already know they're already at 14.4% tax rate in the state of California. And now what they're trying to do is now they're trying to go after a deferred compensation. I know many of you guys who are living in California, or for that matter, even some of the other states where you guys have state income tax. Many times, what people do is they try to defer their income. So, if you're working for big companies like Google, Apple, and some of the other major players out there, there's a good chance that if you are a high income earner, probably if you're earning maybe 250K or more, then you might be taking advantage of deferred compensation. So I want to talk to you a little bit about that, how that works, and what does California wants to do with this deferred compensation. How is that going to affect you? What changes might be coming? We'll see if that happens, but at least California wants to do that. Will they try to do it at state level? Like basically unilaterally try to make some change, maybe, but currently there is a federal law that will prohibit that from doing that. But legislatures, they come up with their own ways of doing stuff. And my job here at the tax court advisors is just to kind of say it as it is, let you guys know what's happening out there so you can be better prepared. All right, so what is deferred compensation? Deferred compensation is income earned today but chosen to be received in the future. So if I earn $500,000, I can say, look, I'm going to take $200,000 as my W-2 income this year, and I'm going to defer another $300,000 for next 3 years. Now, why would you want to do that? There are two main reasons, obviously, tax savings. So if I'm not taking an income, W-2 income, then I don't have to pay taxes on it, right? That's one reason. And then additional savings for retirement or future expenses. Like it gives me ability to plan some things. Um, some strategies can be worked around that to kind of make it a little bit more beneficial for me. Okay. So let's take a look at from a tax perspective. So I'm going to use the F word. In tax world we call it FICA, FICA. I know it's in simple terms, it's your Medicare and Social Security tax, and that are paid on deferred income when earned. So there's nothing you can do about that. Okay. Federal and state taxes are paid on deferred income when it is received. So I hope that makes some sense, right? So we have FICA, which is about 15%. You pay 7.5%, and your employer is paying 7.5%. If you're self-employed, then you are paying the employee and the employer portion. So let's say, if you're making $500,000, then you're paying this heavy FICA. So by deferring that income, so if we go back to that example, you say, look, I'm going to take $200,000 and I'm going to defer the other $300,000 into the future years, then it does not eliminate your FICA. You still pay your FICA, which is about 15%. But your federal and state taxes, so if you are in a great state of California, then you're paying almost 14.4% in state taxes. And once again, I'm really referring to high net worth individuals, people who have really good W-2 earnings. So this video is more relevant to you guys. So you're already paying FICA, which is 15%, and then you're paying almost 14.5% to the state. So you're almost at 30%, and we haven't even touched the net investment tax. We haven't touched the federal tax. So you can just imagine it starts to get expensive. And that's why people consider the deferred compensation, because it helps them out a little bit. So deferred compensation allows for potential tax savings by shifting income to a lower tax bracket in future years. So how would that work? So let's just say maybe I am in my 50s and right now I'm making a lot of money, and then I'm going to plan on retire in 55 or when I'm 60 or something like that. I can plan out so I start taking maybe $100,000 income at that time. So it's kind of like a retirement income. But the beauty is right now I could be in a 50% tax bracket, and a few years from now I will be in, 20% tax bracket. So it's a good savings for me. So that's the idea behind that. Now, IRS has not put any limits on it. So there's no limits on how much can be deferred. You can defer 100,000, 200,000, 500,000, million. But what if you can defer 50 million or 60 million or 70 million, right? And let me just run this thought in your mind for a second. Let's say you defer $50 million, and then maybe 10 years down the road, you don't even live in the state. Now, let's say you move to the Lone Star state of Texas, okay, where there is no state tax at all. What happens to that state income tax that you were supposed to pay? Now, there are some rules around that, but let's just say we ignore those for a second. Now, the state can lose out on that entire income tax because the person is no longer a resident in California. So once again, I know there are some exemptions, there are some procedures you have to follow. First, just stay with me for a second, that you followed those procedures and you avoided those taxes. In that case, that's a great tax planning for you. But that's a revenue lost for California. Okay. So how does that actually work? Okay. So you need to decide. So when you set this plan up with your company, depending upon who you work with, you need to decide when you're going to receive that income. You can receive deferred income before age 59 and a half. And I say that because, some of these, for example, IRA accounts and your other retirement accounts, you have 59 and a half limit. So let's say if you're making good amount of money in your 40s and you want to retire in 50s, that's okay. That's completely fine with income deferral programs. Now, choosing to receive it. So you're an individual, you decide to say, okay, look, I'm going to receive it in my 50s. You have two options. Okay, one, you can say, give me my entire deferred compensation at this age, or you can divide it over a period of time. So once again, when you divide it over the period of time, you're reducing your taxes depending upon which state you're living in, um, and some of the other, maybe you have other ways to reduce your taxable income. Maybe you have some charitable trust going on. There's so many ways. I don't want to get into that. The point is very simple, that if you take a big income and you divide it over a longer period of time, you reduce your taxable income. So that's this whole conversation about deferred compensation is going on. So what happens is this deferred compensation can also be put into an account. So you can also have, tax deferred growth. So you can actually invest that money, which is again a good idea, right? Because if you're not paying taxes on that income and you're able to grow those funds, so that's almost more or less acting like your 401k. So those of you guys who are regular W-2 employees, you guys know there's a limit, right? I think $22,000, 22,500 is the limit. And if you want to put anything more than that, then you run into all kind of restrictions. So with this deferred compensation plan, that's another way to get around that. So not just that you're not paying taxes today, you can actually grow it in a tax-free or tax-deferred method. Let's just say a better word. I mean, it's tax-free right now because you're not paying taxes, but you will have to pay taxes at some point. But you have an ability to kind of plan that out. So that's why it's important. Now, like I said, if you move to a lower state tax state in future, then that's good. That can be a strategy for you. Now, I'm going to talk about some of the problems that state of California is trying to create for this plan just in a second. But before I go there, I want to point your attention to some drawbacks. Sometimes I'll have clients come in and say, "Oh, Deepak, I'm deferring $200,000 a year." Okay. So you want to understand what kind of problems you can get into it by doing that as well. So number one, it is possible that you might be putting that money at risk. So what do I mean by that? See, the money in deferred compensation is not guaranteed. If your employer pays you the funds today, it moves from their bank account to your bank account. It's done. The transaction is complete. After that, you pay your taxes. In deferred compensation, that money is still sitting in your employer's back, bank account. So somebody can go after that money. It could be used to pay for creditors. Company can potentially file for bankruptcy, or maybe they get into some other financial troubles. Things happen all the time. There could be fraud. So all kind of problems can happen because you're not taking those funds right now. So that's one problem. Okay. Now, number two, it's an irrevocable decision. What I mean, so you guys probably, those of you guys who are understand about estate planning, or you might have created an estate, you probably know there's a revocable trust and irrevocable trust. So irrevocable means you cannot make a change, and revocable means that you can make a change. So once you elect this, so once you decide that I'm going to defer the compensation, there's nothing you can do. You cannot undo it. So before you sign on that dotted line, it's a great idea to get in some touch with somebody and make sure that that's the right decision. So I always advise people, whether you're trying to set up an LLC, or you're trying to buy a property, or maybe you're trying to sell a prime residence, or your investment property, any kind of big decision that you're making, good idea to set up a consultation appointment and just run it by them. You know, I guess deferred compensation sounds like, so similar to 401k that you would think that there's nothing wrong with it. But you can imagine not everybody is going to watch this video. And I doubt it that your HR will explain this to you as well. I'm sure it will be already in the paperwork that they give you, but who reads the paperwork, right? So that's the challenge we run into. So it's a good idea to get in touch with somebody and better understand what does this mean for you. So in most companies, I think almost all companies, once you make this decision, you cannot change it. Now, changes may require, if you do have to make a change, like not, you cannot say, oh no, I don't want to, I want to undefer the income. Um, but let's say if changes are required, the changes may require extending the deferral period by 5 years. So and it's really all up to your company. You might want to double check it. But most companies, what they would do in the change, look, if you want to change something, you have to extend the period for 5 years. Now, I'll tell you why. Because, see, company is also managing that money more or less for you, right? So they don't want to be surprised with some random changes that you might decide to do. So that's another reason why you want to consider, is that a right move or not a right move? Okay. Another thing is, let's say if you have money in your account, in your Roth IRA, or self-directed IRA, or even your own brokerage account, you can invest anywhere you like. You can buy Apple stock, you can buy Facebook stock, you can buy an ETF, you can buy a mutual fund, you can buy whatever you like to buy. But some of these deferred compensation plans don't allow you to do that. They will just give you whatever funds they want to offer you, and that's it. That's your restriction. For some of you guys, that might be okay, but for many people, that might be a problem. So keep an eye out on that. Does it actually allows you to invest in everything that you want to invest in? And another thing is, what about if your circumstance change? What about if something changes in your life and you need to access those funds? What do you do? Does your company offer some sort of maybe a loan program against those funds? Probably not. But I want you just to think about it for a second. What if you need to use the money? What are you going to do? So is deferred compensation the best strategy? Maybe if you're an owner of a company and you get to make all the decisions, and you have flexibility and all that. So if you're a small business, you can do this for yourself as well. You can set up plans to do that for yourself, no problem. But is that a right thing to do if you're working for somebody else? So think about that for a second. So evaluate the benefits and drawbacks carefully. And that's why I always recommend people to come back for consultation, because not everything is clear when we watch some random videos online or whatnot. Like for example, even in this video, I'm not covering every aspect of it. I'm not really looking at your situations. I'm not looking at, do you have capital gains? Do you have real estates? Do you have other investments going on? What kind of stuff going on in your retirement? What does your spouse do? What do your kids do? And I have no idea who am I talking to. That's just my general thoughts about this plan. And I'll tell you why I decided to discuss this topic today just in a second here. All right, now if you guys have any questions, I'll take them towards the end. So just give me another 10-15 minutes here just to wrap this up, and then I'll take your questions. I know many people are already putting them up here, so don't worry about that. I'm going to get to those just in a second. So why did I decide to make this video today? So what's happening is the great state of California is once again asking Congress that, hey, this is not fair. We're losing out on money. People are, high net worth individuals are using it as a strategy to circumvent paying the state taxes. They are earning the income here and then they are moving to lower tax states. And that's just not fair to us. So you'll be like, well, if I made $500,000, what difference does it make if I deferred another $100,000, $200,000? Does that impact the state of California? Probably not. But what happened was, in a recent case, I think there was a player at Los Angeles Dodgers, and he had a contract for $700 million. And what he did was, now imagine if he got paid $700 million in California, he would have to pay out $350 million in taxes right away, probably more, but just giving a rough estimate, because he'd be at least bare minimum $350 million. I mean, 50% tax bracket, right? Now, what he did was he deferred $680 million of that over the next 10 years. So he said, I'm going to take $10 million, $20 million this year. So he would probably end up paying $10, $11 million in taxes. I'm sure he probably have a lot of smart tax people working with him, and they will find him some ways to save on taxes. But just in case you don't, and you're watching this video, definitely reach out to us. We'll be happy to help. And then this $680 million will be deferred over the next 10 years. Okay. And in those 10 years, those funds are growing, and from that growth, his plan is to pay for the taxes. Do you see what the strategy here? He will save on taxes because he's not going to pay those federal and state taxes. Those funds will grow because he's investing them. And he's selling, look, what I'll do is every year I'll sell some part of that growth and I'll pay for the taxes. That's the strategy he's using. So in one way, you can think about it that he's avoiding the taxes. Now, he's not planning on, at least I don't know, I don't think he's planning on moving out of California. I think his because that's where he plays, that's where he earns the income. So I doubted that he gonna move out of there. But if he decided to, maybe even deferred it longer and decided to move out, then California can possibly completely lose out on that revenue as well. So, but once again, I think I already told you guys that last week. In 2024, California's top tax rate now is 14.4%. That includes an additional 1.1% payroll tax that they just added. So why does the California feel like that this is not a fair practice? Well, the controller of California is arguing that the current tax system allows unlimited deferrals for high income earners, creating an imbalance in the tax structure and creates inequality. So I think what California is thinking is that, hey, let's not allow people to defer as much as they want. Let's try to put some limits on it. So that's the idea. But like I said, right now Congress has not made, Congress priority is not about dealing with this deferred income. So I don't think they're going to really deal with anything like that. But they might, and right now California cannot take any unilateral action. But those of you guys who are deferring income, I want you to think about this, that the California is already thinking about that. So it's already on top of their mind. So, is that a right strategy? Is there a better way to save on taxes? Is there better tax planning that we can do? Or should you be deferring as much as you are deferring? Maybe you want to defer a little bit and then do something else with the rest of the money. So those are all the kind of questions I want you guys to think about that. Um, so anyhow, I'm going to take the question just in a second, but I'm going to stop the recording here. I'm going to post this on our YouTube and Facebook channel. And those of you guys who are watching us, if you want to join us, there are plenty of free ways for you to connect with me. You can set up a free discovery call for 15 minutes, and I can get to learn about you. You get to learn about our firm and see how we can help you, what kind of value we can bring to you. I run a small business advisory group where we focus on how to grow small business. And then on top of that, I run these market outlook meetings every 2 weeks where we talk about how our economy is doing, how is our country doing, where do we see the market is heading, trying to kind of like act like a filter for you to take all this information that's getting thrown at us every single day and just filter it out and give you a summary of it. So that's the idea. I want to save you time. I want to save you money. I want to help you save, grow, and protect your money. So thank you so much, guys. Just head over to taxcodeadvisors.com and set up a discovery call. Thank you. Okay, so I think that was my marketing. So we can go back to our questions now. So let's see who is first here. Okay, so Rakesh, you have a question. Go ahead, please.